I'm a tax partner with Davidson and Company, for those of you who I've not had a chance to meet. So we have a live audience with us today, which is great to see here in person after a few years of having to hide behind some computer screens, as well as those of you at home who've chosen to watch in your PJs and enjoy it from there. So we have a number of interesting topics, tax topics for you today. Most of them have been chosen mainly from the, I guess, areas of interest we've had from a lot of our clients in the last year or two, topics that have had a lot of questions around them, and hopefully we can answer some of those for you today. We will be shifting to the networking component of our day at around 4 o'clock once we've gotten through the session. So look forward to chatting with our people in person and our audience here. So before we get started, just wanted to mention there is a Q&A function on the Zoom call as well. If you do have questions here, there's a notepad on your chairs, so you can write down your questions and hold up your hand, and someone from our admin team will come by and collect them for you. We'll go through the topics this year. Sometime, or in the past, we've taken questions in between. Today, what we'll do is we'll go through all the topics and then save some time at the end for the Q&A. So we'll get started with that. Another housekeeping item I just wanted to mention, for those of you requiring PD, the PD certificate, as well as the slides and the video, will be made available to you after you complete the survey following the session. So we do encourage you to do so. Moving on to the topics. So we have a federal budget tax update that my partner Jamie will cover today. There have been a number of changes that came through in the past year, so he will guide us through the various changes that came through in this last budget. Unfortunately, our colleague Howard Chang was not able to join us today. He's ill and staying at home, so we do hope him well, and he'll be back soon. I will be covering for Howard today and hopefully be able to get through all the details without too many stumbles. Following that, we'll have NAMIR HALLAK, principal from our team, who will be covering the various new U.S. tax changes that have come through, and a number of areas that also impact our clients in the cannabis industry. So some good details there to come. He'll be followed by Frank Lin, our principal from our Canadian tax team, who will be covering various issues on the flow-through share regime, some of the new things, new developments, and the changes that came through. I know it's been a area of quite a bit of activity in the last year or two, so I'm sure that there will be some interest in that. And then I'll be following it up at the end with another area that's been quite a hot topic or hot topics for our public company clients. That would be GST with holding companies, as well as stock compensation options and various basic areas there. We'll have as I mentioned, we'll have a Q&A session following that, so please don't hesitate to send us your questions, and we'll try and get through as many as we can. So without further ado, I am going to pass it on to my partner, Jamie.
Thanks, Les. Nice to see everyone. Finally, nice to see some people here in person. So for those of you who don't know me, my name is Jamie Nguyen. I'm a Canadian tax partner with a focus on private companies and high net worth individuals. So today I'll be speaking on the federal budget tax changes that was presented on April 7th this year. So there's obviously a lot of tax measures that were discussed. I'll be focusing primarily on the tax measures that affected private companies and individuals, and there's a lot to cover. So in general, there's a lot of rules surrounding tax deferral, getting rid of tax deferral for private companies and lots of real estate. So I think that'll be quite interesting for a lot of you watching. So let's get started. The first topic is on the small business deduction. I'll give you guys, for most of my slides, I'll be giving you guys a bit of a background just so you guys can kind of catch up and understand the gist of these proposed changes. So with small business deduction, most of you know for Canadian-controlled private corporations, they are eligible for the small business deduction on active business income. And so what this does is on the first $500,000 of active business income, they get this nice preferable tax rate. So if you think of a company that operates in BC, they pay this nice low 11% corporate income tax rate. And if there's any active business income over that threshold, or they're not eligible for the small business deduction, they pay 27%. So 16% spread there. So this small business deduction is kind of geared towards smaller CCPCs. And so what ends up happening, a lot of people don't realize, is there's this phase out of the small business deduction when the taxable capital gets high. And so the taxable capital employed in Canada definition is quite complex, but for purposes of this seminar, just assume it's retained earnings, plus your long-term debt. You get to deduct certain items like your loans receivable and investments in other corporations. So what ends up happening is once your taxable capital exceeds $10 million, it starts to phase out the small business deduction on a straight line. So and at $15 million of taxable capital, the small business deduction is completely gone, meaning all of your active business income that would otherwise be eligible for the small business deduction gets taxed at 27% in BC. So one of the proposals in the budget it's a good thing, is to basically expand that taxable capital range and basically give more room for CCPCs to claim and use up that small business deduction. So instead of the taxable capital range being from 10 to 15 million, it's now 10 to 50 million. And this would be for taxation years beginning on or after budget date of April 7th, 2022. So as an example, if you have a CCPC, and again, this actually, the taxable capital, I should say, applies for an associated group. So if you have multiple companies in the associated group, you'd add up the taxable capital for all of them when looking at this threshold. So if you think of the existing rules, if a CCPC had taxable capital of 30 million, say, the small business deduction would be completely phased out, so they would not get any of that for the following year. Whereas under these proposed rules, at 30 million, you still actually have half of that limit, $250,000, that would be available for the small business deduction. So a very welcome change. The taxable capital range has not changed in forever, so this is definitely a welcome change. Next is this substantive CCPC new definition. I don't think it's going to impact a lot of companies, but it's basically an anti-avoidance rule. So again, some background here. So as I just mentioned, if you're a CCPC, you get this nice favorable rate on active business income, but when it comes to investment income, there's actually a very high upfront tax. In BC, it would be 51%, so it's 50.67%. So the purpose behind that existing rule is to prevent CCPCs from accumulating too much investment income in the company. And if you contrast that with non-CCPCs, they pay this nice flat, low tax rate on all of their income, whether it's active business or investment income. So they only really pay 27% in BC. So what was happening on certain types of transactions is companies were purposely trying to avoid the CCPC status. They would purposely try to be a non-CCPC. And one of the ways you could do it, for example, is if a non-resident company or a public company had the ability to acquire the target entity, even though that target company may have actually been controlled by Canadian resident individuals, for example, that it would actually be a non-CCPC under the current rules. And so what would end up happening is that target company, it was perceived by the government that they were manipulating that to get a nice low tax rate on, say, capital gains in a sale transaction. So the proposal is now to introduce this new definition, the substantive CCPC definition. And if you fall in that, you're basically going to get taxed at that 51% rate. So a substantive CCPC is basically a company that's normally a non-CCPC. It's a private company, but in fact it is actually controlled by Canadian residents. So if you truly are a non-CCPC, like you are actually controlled by non-residents, this rule isn't going to affect you. It's for the underlying companies where the control really is with Canadian residents. So again, it's an anti-avoidance provision. And so what ends up happening is the non-CCPC or the substantive CCPC in that case would be subject to that high investment income tax rate. And they would actually not be eligible for all the other benefits that a CCPC normally gets. So no small business deduction, eligible dividends, all that would kind of go away. So it actually makes it quite punitive if you end up in that substantive CCPC definition. Moving on, another change that is impacting CCPCs is this foreign accrual property income. So when it comes to Canadian taxpayers that hold investments, there's this idea, and this comes up a lot in our practice, is people want to store their investments offshore, right? They want to put it in a nice Caribbean country where the tax rate is low, and they say, well, I'm just going to park that money in a Caribbean company and just pay a really low tax rate, right? And I won't repatriate that money to my Canadian corporation, right? I'll just take advantage of a really low tax rate. And the foreign accrual property income rules basically avoid that from happening. It basically pierces through that corporate veil, and it actually pulls that investment income in that foreign jurisdiction onto the Canadian taxpayer's tax return. So you are effectively paying tax even though that income has not actually been repatriated into Canada. So what ends up happening is there are obviously situations where the foreign company does pay foreign tax in that jurisdiction, and to avoid a double taxation, when you're calculating that FAPI amount, there is a deduction for that foreign tax, and it's equal to the foreign tax times what we call this relevant tax factor. And that relevant tax factor is defined in the Income Tax Act, and for Canadian corporations, that factor is 4, whereas for individuals, it's only 1.9. So if you think about it, if in that foreign jurisdiction, you're paying a foreign tax rate of, say, 25%, you multiply that 4, you'd basically clear out any of the investment income that you would otherwise have to include. So very, very good for situations where you do actually have foreign income in a foreign jurisdiction and you're paying a relatively high rate. And again, obviously, if you're paying at a really low rate, you're not going to get as big of a deduction. So the reason why the Canadian corporation has a higher relevant tax factor is to factor in the extra layer of tax that has to happen on the repatriation of income to the shareholder. So that's the background of it. And in the proposal, again, if you pay 25% tax, a tax rate of 25% in that foreign jurisdiction, you theoretically could still be better off than paying 51% in Canada on that same investment income. So the proposal here is to actually eliminate that tax deferral opportunity. And so now what budget's proposing is to reduce that relevant tax factor for Canadian corporations down to 1.9. So theoretically, if you take 100 divided by 1.9, you're probably at like 51, 52%. That's basically, if you're trying to avoid including FAPI, a net FAPI amount in your income, you'd have to pay 51, 52% in that foreign jurisdiction to basically wipe out the income inclusion, which is very, very hard to do because obviously in Canada, we pay very high tax rates. So that's actually a summary of most of the corporation changes. I would say most of the good stuff or the interesting stuff is actually on the personal or individual side. So that's what I'll be talking about now. So the biggest one of all the federal budget tax changes is this new tax-free first home savings account. So there's been a lot of chatter about obviously the real estate market going up in Canada and the ability for Canadians to afford housing in Canada. As most of you know, there are some measures to help individuals buy homes in Canada. There's the home buyers plan, where you can basically pull money out of your RSPs and pay it back over a period of time. You presumably use that money to then put a down payment on a house, for example. But those existing rules are quite limited in being able to afford a house, for example, in Canada. So the proposal in budget is to introduce a new registered account. As many of you know, we have RSPs, we have RIFs, we have TFSAs, registered accounts. There's this new tax-free first home savings account to help Canadians purchase their first home. And this will be for effective in 2023. So the best way, I was trying to figure out a way to explain this, and it's basically a hybrid between an RSP and a TFSA, and it actually takes the best of both worlds. So again, this is a very welcome change. I think it's going to be very positive for Canadians. So what ends up happening is you make a contribution to this new account. The contribution is tax deductible on your return, and on the tail end, it's actually tax-free when you pull it out and apply it to your new home. Very similar to a TFSA, as you guys know, when you put any income generated in that TFSA is tax-free. So there obviously are parameters around this new registered account. There are annual contribution limits of $8,000. You can't accumulate, like if you miss 8,000 in 1 year, you can't do 16,000 in the following year. It's 8,000 per year, and over your lifetime, you can only do $40,000. So theoretically, if you did it over 5, you could contribute the max amount for your lifetime over 5 years, for example, 5 times 8. So again, the purpose of it is to allow Canadians to purchase homes. So a qualifying withdrawal, they call it qualifying withdrawal, would be non-taxable. So again, using that money to put it into a down payment, for example. Other eligibility criteria, you have to be a Canadian resident, at least 18 years of age. You cannot have owned the home in the current year, a home in your current year or the 4 preceding years. So basically over a 5-year period, you cannot own a home, again, targeted towards Canadians buying their first home. And it only really applies to one property in your lifetime. So it's kind of a one-time shot. And once the withdrawal is made, the account must be closed within a year, and you're not eligible to open up another one. So some other, we kind of briefly read the legislation and the budget on it. I think it's quite well thought out. They thought about what happens in a situation where you don't end up buying your first home, and there's actually an ability to transfer the funds to an RSP or a RIF, and you can actually roll that into your RSP or your RIF on a tax-deferred basis. So it's going to be quite useful for a lot of people who suddenly find out, you have 15 years to basically buy the home. If in a situation after 15 years you can't buy it, there's this ability to roll it into your RSP, and it won't actually encroach on your existing RSP room. So it'll be kind of interesting, I think, to see if there's any kind of tax planning around that, especially in situations where an RSP is already maxed out. But definitely a lot of options here in an event where you don't end up buying the house. Next is the first-time homebuyers tax credit. So most of you know, if you're buying your first home, you actually are eligible for a tax credit on your return. The current tax credit is $5,000 times 15%, so you get tax savings of up to $750. The home must be in Canada. Some of the criteria here, the home must be in Canada. You can't have owned a home in the previous 4 years as well. And you must occupy the home in the year of purchase, within a year of purchase. So the proposal under budget is to basically double that credit. So it'll jump up from $750 of tax savings to $1,500. So again, a very welcome change, and that would be for acquisitions made on or after January 1st of this year. So effectively, right now it will apply. The other one that actually was talked at budget and actually got royal assent last month was the home accessibility tax credit, and that got doubled from $10,000 to $20,000. So the effective tax savings is now $3,000. So for those of you who don't know, the home accessibility tax credit is geared more towards seniors or those with disabilities, and it allows you to make, for example, a renovation in your home for better access. If you have to, install a ramp or something like that to get up the stairs, that would qualify. So again, very, very good news here. They're doubling the credit in that situation. The next one is also a very significant change and a very positive change, I think. It's the multi-generational home renovation tax credit. And in the budget, finance mentioned that there's a lot of multi-generational homes in Canada. So you think of a situation where someone's, for example, living with a parent or a grandparent. And so what they wanted to do is introduce this new credit for the 2023 and future years that would help that across the country. So this is a refundable credit. So contrast that with most credits, which are non-refundable, meaning the government potentially could actually give you money. And the tax credit is equal to 15% of the lesser of the actual expense, or $50,000. So potentially a savings of up to $7,500. So the purpose behind this is to basically allow Canadians to do a qualifying renovation that would create a secondary dwelling unit that would permit an eligible person to live with a qualifying relation. So the eligible person, I'm trying to break this down, the eligible person is basically the person that's going to be living with you. So if I think of myself, the eligible person has to be a senior, someone over 65 years or 65 years of age or older, or has an adult with a disability. So if you think of a situation where I'm going to have my parents, for example, come live with me, and my home right now doesn't have a secondary unit, I could actually build a unit and get this tax credit. Some of the other important details of eligible expenses, not all expenses will qualify. You know, you think of typical construction costs, labor, fixtures, equipment rentals, those will all qualify. Non-eligible expenses would be items that, like furniture, would not, financing costs and just upkeep of the house would not be permissible. So again, there's a definition here of a qualifying renovation, and the main takeaway here is it has to be a secondary unit, a self-contained dwelling unit with a private entrance, a kitchen, bathroom facilities, and a sleeping area. So, you know, if Frank wants to build a tent in his backyard, that's probably not going to qualify. So if there's ever, and the other important part is permits are needed. So again, if Frank's trying to just kind of build this on his own, probably not going to qualify. You're going to need permits for this. So if there's ever a time for you to try and get your in-laws to come live with you, now would be the time. Another big rule or proposal that came out is this residential property flipping rule. And I think this is the one that's going to get the most news, I think, over the coming year. And so I'll kind of give you guys some background here, because this topic can get quite complicated. So many of you know when you sell real estate, and if there's any gains, it needs to be included on your tax return. And so the way we classify it on your tax return is it's either on account of income or it's on account of capital. If it's on account of capital, most of you know it's only taxed at 50%. If it's on account of income, which we sometimes refer to as business income, that gain is 100% taxable. So definitely not favorable to get at a gain to be treated as business income. Furthermore, if you want to claim the principal residence exemption on a property, it needs to be capital property. So again, there's this shift, you know, there's this idea that obviously that you'd want to try and get capital treatment as much as possible. And so a lot of how you determine if it's on account of income or capital is based on your intention, right? You know, if I intend to live in that property, I go and actually live in it for several years, and then I sell the property, that's probably on account of capital, and you know, I'm probably going to be eligible for the principal residence exemption. Conversely, if I buy the property and I just basically intend to flip it, I'm going to do a small renovation, I'm going to flip it a few months later, that is generally going to be treated on account of income. And so, as you can tell, whenever a rule or a tax treatment is based on intention, there's a bit of a gray area, and the government basically felt that Canadian taxpayers were taking very aggressive positions. They were often saying, well, it's on account of capital. You know, I'm going to keep picking on Frank here. Frank's going to buy a property, he's going to live in it for 6 months, and then he's going to sell it. And what's Frank going to say? He's going to say, well, it was my principal residence. I had to leave for various reasons, right? That's why I intended to sell it. It's not on account of income. I want to claim the principal residence exemption. And if the principal residence exemption was not available, he'd at least get capital treatment, right? 50% taxable. You know, Frank's better off than the full gain being taxable. So the proposal here, again, there's that gray area, and now with this proposal, the government is trying to introduce more of a bright line test. And in a nutshell, the proposal is that if Frank, in my example, sells the property within 12 months of owning it, it's going to be income. It's going to be deemed to be business income. So any profits he has will be 100% taxable. So no principal residence exemption, no capital gain treatment. Just, it's the most punitive situation you can get. And the legislation was actually released, the draft legislation, again, this was proposed. The draft legislation that came out last month also indicates that they would not allow a business loss to be claimed. So if Frank gambled on this property, sold it at a loss, he would not even get to claim the loss, which is, again, very, very punitive. So there are some exclusions to this deeming rule. It's not all sales within 12 months would be subject to business income. So they're what they call life events. So there's a death in the family, a household addition, separation or marriage breakdown, personal safety, disability or illness, employment change, insolvency, and some sort of involuntary disposition. So, you know, if there's a natural disaster. So even if you can somehow dodge or get out of the deeming rules, that still doesn't even necessarily mean you're going to get capital treatment. So the government's even said it's still a question of fact whether the sale would be on account of income or capital. So this is just to get you out of the deeming rules. So this is, you know, I think this is going to raise a lot of press over the upcoming year or so, and so we'll end up seeing what happens. And so this would, just to kind of go back to my previous slide here, this would be effective for any residential property sold after the end of this year. So Frank, you might want to sell that property sometime this year, in the next few months. So this is not really a proposal in this situation, but something that was announced at budget. And so they've expressed concern that high income earners are not paying sufficient income taxes. Right now, as many of you know, we do have an alternative minimum tax in our legislation, but the government's concern is that these rules are outdated. So they've announced that their intention is to examine a potentially new minimum tax regime, and they'll announce it at the upcoming fall update. So we'll see how that looks. I imagine it's probably not going to work in tandem with the existing AMT rules. It'll probably just be a revamping of it, but we'll see what they come out with. Another topic that's on real estate is GST on assignment sales. So I see this a lot in practice, I think because a lot of our clients deal with real estate. So an assignment sale, if you think of a very typical situation where, I'm going to use Frank as another example here, where Frank buys a pre-sale condo, he enters into a contract to buy a pre-sale condo that's going to be finished in, say, 3 years. He, you know, puts a deposit down, and then before completion, he sells that contract to, say, NAMIR, right? And so there's a question of, you know, from an income tax perspective, that's obviously reportable. The one tax that often gets overlooked is how GST applies in that situation. And so similar to the previous proposal, GST, the application of GST on that assignment sale is based on the intention of Frank in this situation. So if Frank's intention was to live in the property, you know, and then something happened, he had to sell that contract, it's going to be exempt from GST. On the other hand, if Frank's intention all along was to make a profit and flip the contract, then it's going to be subject to GST. Again, some uncertainty there because no one really knows what Frank is thinking, and so the government really wanted to create more of a bright line test here, because oftentimes, even when we see it, it does get missed, and people don't understand the nuances of that rule. So the proposal here is to eliminate the uncertainty, create a bright line test, and basically make all assignment sales subject to GST, and that would be effective for any sales, or sorry, any assignments entered into on or after the month is 1 month after the budget date. So May 6, 2022, for example, and forward. The other issue that came up here is in my example where Frank sells the pre-sale contract to NAMIR, and NAMIR has to eventually close it with the developer, that developer is going to charge GST on the final purchase, on the final sale price, because it's new property. So there's this issue about potential double taxation, right? Because presumably Frank's sale proceeds includes a deposit, right, that he laid down with the developer. So to avoid that double taxation of the GST, the deposit portion would get carved out, and so GST would presumably not apply on that deposit part of the sale proceeds. And so this one is actually no longer proposed. It was actually, it came through on Bill C-19, so it did receive royal assent, so it is now enacted. So, Frank, if you sold that assignment, that contract to NAMIR, hopefully you charged GST. So that's it on the federal tax highlights. Just quick summary again. So changes to the small business deduction, expanding that phase out of the small business deduction for taxable capital, introducing these tests for the substantive CCPCs and the FAPI rules. There's on the individual side, there's the new tax-free first home savings account, the multi-generational home renovation tax credit, this big rule on deeming business income for property sales within 12 months, and assignment sales for individuals. GST will now apply on that. And with that, I'm going to turn it over to Les, sorry, for you.
Howard. Thanks, Jamie.
Thanks.
All right, I know that was a bit of a quick summary of all those changes that Jamie went through, but certainly each one of them has some significant impact. So if you have questions on that, don't hesitate to reach out to us, and we'll try and do what we can to answer them. So yeah, the next topic, which often comes up with companies that are obviously profitable, but they have a component or maybe a subsidiary that has losses in it. How do you combine the two, since in Canada you can't consolidate companies for tax purposes where you offset losses from one against profits from another. So it requires some more careful planning and arrangement. So to get started, what we're going to run through are just the basic elements of what losses are for Canadian tax purposes and their classifications. Some of the restriction rules that are stop loss rules that come into play and when they would apply, and some of the examples that we have for sort of loss utilization. So just in the background categorizing, so there's mainly two types of losses that we have for Canadian tax purposes. You've got non-capital, which are essentially your operating losses that are from business or property. And the other is what we call capital losses, and they would be from capital items that would not be your normal business, but would be more the exception. The analogy that they often use is the fruit and the tree. If you were to sell the tree, that would be capital. If you sell the fruit, that'd be income. So it's that sort of concept. So each business or property can have a separate source of income, which can apply or make a difference in some cases. What's added to taxable income and taxable capital gains, allowable capital losses. These are currently the ratio is capital gains are taxed at half of the actual gain, and losses equally are only allowed to be written off on half of the actual loss. So the net is what ends up in taxable income. As it says, allowable capital losses can only be applied against taxable capital gains, so they're of course more restrictive than non-capital losses. Non-capital losses have carry forward of 20 years and a carry back of 3 years, whereas capital losses have an indefinite period of carry forward and can also be carried back 3 years. So the recognition, I guess, there has to be a profit motive involved in order to be able to claim losses and have a commercial business. Certain types of transactions with affiliated persons are what are known as suspended losses. So they essentially are restricted until there is a arm's length party that either the asset is sold to or comes into play. So Suspended losses are really where they're either maybe added to the cost of the property for the future disposition, and it just depends on the circumstances. There's also some specific stop loss rules with when you sell something and when you repurchase an identical property. And the other is just general anti-avoidance rules, or GAR, which can apply in various situations if it's abusive or seen to be taking advantage of a tax provision. So to go into the details of what an affiliated person is, so an individual is affiliated with themselves and their spouse when it comes to individual people, but corporations can also be affiliated with individuals or with other corporations. So those would be any person who controls the corporation would be affiliated with the corporation. Another corporation, if it's controlled by the same person, and as well if another corporation, each of which is controlled by a person, and the two persons are affiliated, then they too would fall into that category. So there's a lot of situations where if you're trying to move assets around in a related group, these types of rules can kick in, and they can basically suspend the loss until such time as the asset's sold off to an unrelated person. And when we say control, it can, de facto control goes beyond necessarily what's known as de jure control or legal control, where you hold more than 50% of the shares. If you actually control because of other means that are not clear or obvious, that can also play into it. So the way suspended losses work, just a few examples to go through. So depreciable property, things like a building, if there is a loss on it, then the loss is suspended in the transferor's hands and cannot be claimed until it's disposed of to an arm's length person, as mentioned. Other capital properties, say stock or land, they can also be suspended in the transferor's hands if it's transferred to an affiliated person at a loss. If it's a disposition of debt to a related party, the loss can be added to the cost base of the debt held by the related party. So there's usually triggering events that will release these losses once they're transferred to a non-affiliated person. So one of the areas that we do get a lot of questions on are where there's transactions that involve wind-ups or amalgamations. So where you've got a wind-up and you've got a subsidiary being wound up into and we'll do this on a timeline, where a subsidiary may be wound up into its parent company, there's basically a line drawn where the date of the wind-up affects whether you can carry forward or carry back losses. And typically it's the way that it works is a parent of that situation can carry forward its losses and use it against the amalgamated companies or combined companies' profits after the wind-up date, and the parent's losses past that date can be carried back to the parent's income prior to the wind-up. However, the subsidiary can only carry forward its losses. It cannot carry it back against subsidiary, the income of the subsidiary prior to that. So you can't, this is meant to avoid situations where a parent company will have losses after the wind-up date and wants to carry it back to the sub income and try and claim it under that. So there's rules that prevent you from taking advantage of those types of situations, because really they can manipulate it in a wind-up just for the purposes of combining income and losses as an offset. And in this case, just to be clear, this is where situations where the subsidiary is owned at least 90% or more by that Canadian parent company. So amalgamation, similarly, there's a timeline where you have a date of amalgamation. You've got the pre-amalgamation period. You've got a post-amalgamation period. The predecessor's losses, that's really the parent in this case, where it's a vertical amalgamation. The amalgamated company's losses can get carried back against profits of the parent predecessor only, but they can't be carried back to the subsidiary's losses. So they can only go back as far as the amalgamation date if the amalgamated company has losses. In the cases where it's a horizontal, it too is a similar situation where it can only go back to the date of amalgamation. They can't carry back to the periods prior for the predecessor companies. So some of the other ways to get around those rules where you've got those types of situations can include things like transferring income within the corporate group, and this could be through management fees or lease payments. However, you want to be really careful with this because this is an area where CRA really likes to challenge, and it can lead to issues where you may even end up with double taxation if you're not careful. So the main consideration really is it has to be reasonable. So when we say reasonable, it's would you pay an unrelated person that much to do the service that it's providing? So if you're really just trying to move profits around, but that other company is really not providing some type of service to the paying company, then it can be disallowed or denied, but you could still end up with the receiving company being taxed on that income. The company trying to take the deduction would be denied the deduction. So that's where the double taxation can come into play. So you want to be sure that there's consideration of, is this at market value? Are the services that one company is providing to another, are they actually justified by, what market rates would be? A couple of the other ones to consider: transfer pricing, of course, where you've got companies that are in different countries, and you've got transfer pricing rules that kick in. They, again, will require you to have those rates at fair market value and not some reduced amount that's really just for planning purposes or to save taxes. You may also encounter some sales tax along the way if you've got management fees. There are ways to get around the sales tax, but in some cases it's not that simple. And the biggest key to, if you are going down this road, is to make sure you have adequate documentation. There should be an agreement in place that's a bona fide legal agreement that lays out all the terms and what the service is. There's invoices issued, there's a history of payments. So as if you're dealing with an arm's length person, you want to make sure that you've considered all those areas. So we'll try and get through this quickly. One of the other types of ways to utilize losses or structures that you could do, you've got a profit company that has a subsidiary that's losing money. The profit company has a gain that's unrealized gain in an asset that it wants to try and shelter from tax prior to selling it. It would transfer the asset to the loss company on a tax-deferred basis, so typically Section 85. It would take back shares of the loss company in return in order to make it a tax-deferred transaction. The profit company would then hold more shares of the loss co, and loss co would hold the asset. So then loss co would realize the gain since it receives that asset on a deferred basis. It essentially inherits the cost base that the parent company had on it. It then realizes the gain, and now we've simplified this. There's always GAR, general anti-avoidance rules, that you would have to consider. So this is just a very basic outline. So similar to that, you can use what's known as a preferred share loan. So bank would loan money to the profit company. It would use that money to subscribe for shares of the subsidiary. Subsidiary would loan that money back to the profit company, and then it would repay the bank. What happens there is the profit company can pay interest to the loss company and shelter that income with the losses of the loss company. Loss company in turn can pay dividends back up to the parent. And if it is 100% owned and they're both Canadian companies, those dividends should be tax-free. So you've now created income in the loss co, a deduction in the profit co, and you've tried to maximize your efficiencies for tax. So one of the keys to losses is really the concept of acquisition of control. So if you do have an acquisition of control, The basic rules are that non-capital losses, they require the business after the acquisition to be the same or similar business in order for those pre-acquisition losses to stream through to the post-acquisition period to be used against income that's post-acquisition. So that's for non-capital losses, of course. The same would apply on any losses prior to carrying back to the same business beforehand. So on property income, as we mentioned, there's different streams of income. It would also be restricted to the date of the acquisition of control and could only be carried back to that same date. So they're much more restrictive because of the more passive nature of the property income as opposed to active business. Net capital losses, they expire upon an acquisition of control, so there's no ability to carry those past the acquisition date to be used post. But there are strategies that come into play, which we'll get to in a moment, where you have an elective measure on the acquisition of control or immediately before that allows you to realize any unrealized gains on your assets prior to that, so you can use up those capital losses prior to the acquisition. So, as mentioned, you can bump up the cost base of assets, certain properties, when you have an acquisition of control in order to use up those losses. So there are various times where you might want to bump it up, use up the losses. Going forward, you have a higher cost base on those assets. Other ways would really be to, you have discretionary deductions, things like tax depreciation or capital cost allowance. You can use your discretion to reduce those to try and increase the income. Potentially amending prior discretionary deductions taken so that you can reduce your losses carrying forward and increase your tax basis on those assets post-acquisition. Using the non-cap losses against Part 4 tax, it's a special tax where it's generally with private companies and involves dividends. Or you can elect to capitalize certain types of interest on debt that are depending on what they're used for. If you have for certain types of property, you don't take it as a current deduction, you can capitalize it as part of the asset for future deduction. So that was just a quick summary of the losses. Unfortunately, in Canada, we don't, like we've said, there's no consolidation of profits against losses in a related group like you might see in the US. Each one of them individually has to account for their own, so it requires a little bit more stick handling to get more efficiency among the group in order to offset losses of one with income from another. They track the source of those losses, so that has to be kept in mind. And of course, the acquisition of control being a significant loss restriction event that one would need to be careful of to ensure they want to maintain those losses going forward. And if you are, it can be quite, it can be a challenge even to prove it then. There have been several court cases over the years trying to defend what's the same or similar business concept. Things like mining, you might have two mining companies that you would think, well, they're all in mining, but it could be, what type of mining they're doing, what's the nature of their industry versus another mining company that can still create problems if you try and use that concept. So I think that's it for our quick summary of losses. I'll hand it over to NAMIR now, and he'll talk about some US tax.
All right, thank you, Les, and thank you, Jamie, and thank you to everyone who's here with us in person as well as virtually. So my name is NAMIR HALLAK, and I will be providing the annual US tax update because it's always interesting to see what's happening south of the border. We're going to talk about two things. One is the Inflation Reduction Act, as well as a Cannabis CBD 2022 US tax update. So Inflation Reduction Act, which by the way I might just call it IRA because it's a lot of words. So this was passed about a month ago on August 16, 2022 by President Biden. And this is a dramatically pared down version of the Build Back Better Act from last year, which was proposed. And after months of political wrangling, only really a small portion of that Build Back Better Act has now made it narrowly to the finish line. So what's the hope with the Inflation Reduction Act? Well, they're hoping that this will slow or curtail inflation. How are they hoping to do this? Well, they're going to increase taxes on some big corporations. We'll talk about that in a bit. They want to expand green use and production tax incentives, extend subsidies on healthcare insurance premiums, and actually, similar to the budget proposals that were mentioned by Jamie, some of this is also targeted towards homeowners and home renovators, not so much the in-laws, but you will see some similarities there. And the other big outcome with the Inflation Reduction Act is they are pouring a ton of money into the IRS. We'll talk about that as well. All right, so the Inflation Reduction Act, it got passed a month ago. Now what? Well, what comes next is the Treasury and the IRS need to come up with new guidance to figure out how do we apply these rules. And that's usually in the form of regulations. Oh, by the way, all that money they're going to pour into the IRS, none of that is being allocated to this, regulatory funding to provide new guidance. Oh, and by the way, the IRS has been severely short-staffed in the last few years. So, what could go wrong? All right, let's talk about some of the key components of the Inflation Reduction Act. We're going to start out by talking first on this 15% minimum tax on applicable corporations. So if you're a corporation or not an S corp, if you're a corporation with average AFSI, again, I'm going to call it that because AFSI is basically your applicable financial statement income. So think of it from a book perspective. So if you're a corporation with average AFSI over a 3-year period, and that average amount exceeds $1 billion, yes, $1 billion, then you are going to be subject to that 15% minimum tax. So obviously, this is probably only going to apply to a select lucky few companies who are going to exceed that $1 billion for those tax years that begin after 2022. One thing to keep in mind though with that $1 billion threshold is that they are using the aggregation rules. So essentially what this means is that the $1 billion test is done for a group of related companies. So for example, you have a US corporate subsidiary, and in that group of related companies, you have a foreign parent company, and that related group of companies exceeds $1 billion in their AFSI over the average last 3 years. It would be applying to that US subsidiary if that US subsidiary on its own has $100 million in AFSI over the last 3 years. Another thing to keep in mind with this 15% minimum tax is once a corporation or that group exceeds that $1 billion threshold, the corporation will remain subject to these 15% minimum tax going forward. Now, the Treasury may at some point issue some guidance or some regulations to help us figure out, well, what happens when a corporation or a group, their revenue goes down, or what happens if there's some sort of change of ownership. So we haven't figured that out yet, and the IRS is probably going to give us hopefully some regs and guidance on that soon. So how does the mechanics of that 15% tax work? Well, essentially what it is it's a 15% tax on your AFSI over your regular corporate income tax for the year. So what you're looking at when you're talking about AFSI is you're looking at the book income of the company, including any income from disregarded entities, from a partnership, or any CFCs if you have. So that's a controlled foreign company beneath the US entity. Another nice attribute about how they've applied these rules is just like NOLs work, the net operating losses for regular tax, if you do have any book losses, they can be used to offset 80% of your income in subsequent years. The other thing too is if you have a minimum tax credit, you can also use it to have a carryover to offset income in a future year. An interesting piece here with the mechanics also of the calculation is when you're doing the minimum 15% tax, they do require to use tax depreciation to reduce the AFSI. And so what that essentially does is it provides tax preference for any capital investments. On the other hand, if you're a company that does not have capital investments, and instead you have more intangible assets, it does not provide you the similar protection. So your AFSI, your overall book income, will be higher and potentially subject to these 15% minimum tax. One thing I just want to add here is with regards to OECD pillar rules. So when we talk about the OECD, they provide basically models or guidance for international tax reform for different countries to figure out, how do we address tax challenges, especially in a digital economy. And they do provide for a 15% global minimum tax. The words here sound similar because we are talking about a 15% minimum tax, but actually there are still some material differences between the OECD Pillar 2 model rules and what's being legislated here. And the reason I bring that up is that other countries may look at this and say, you know what, this doesn't actually match up with the OECD rules, and they'll have their own Pillar 2 top of taxes on those US groups, even though they're already subject to that 15% minimum tax. All right, 1% excise tax on stock buybacks. So buybacks of stocks can be great for corporations. It can improve your earnings per share, it can improve your stock prices. But what the IRS is introducing here is a 1% excise tax on certain repurchases or redemptions of any covered corporations on their own stock. And that excise tax, by the way, is not deductible for income tax purposes. Now, when you are looking at this tax, you do apply the netting rule, which essentially means that the amount that's going to be subject to excise taxes will be reduced by the fair market value of any stock issued in the year, including any stock issued to employees. So the covered corporations that are going to be subject to this excise tax include any US publicly traded corporations, as well as any US affiliates of public foreign groups. Now, there are some exceptions to the 1% excise tax. If you have repurchases that are part of a reorg, where there's no gain or loss to the shareholder, as well as any repurchases of stock that are going to be contributed to an employee retirement or a stock ownership plan. Are there ways for a corporation to avoid this tax? Well, a company can choose to pay dividends instead of repurchasing the stock. Another tool out there is, a corporation could go out there and just say, we're going to impose transfer restrictions on our stock. Not sure the shareholders are going to love that option, though. Now, the next one I'll talk about here is this excess business loss limitation. So what the Inflation Reduction Act did is it essentially extended this limitation on excess business losses to non-corporate taxpayers by 2 years, up to January 1, 2029. So when we're talking about non-corporate taxpayers, we're talking about individuals, sole proprietors, partners, or an S-corp shareholder. It does not apply at the pass-through entity level. And when we're talking about excess business losses, this is the excess of aggregate deductions for the tax year from a taxpayer's trade or businesses over the sum of two items. One, your aggregate gross business income and gain, and then a $250,000 annually adjusted for inflation. And I bring that up because when you look at 2022, that amount has actually gone up to $270,000 or $540,000 if you're married filing jointly. So what is this? Why does this matter for non-corporate taxpayers? Well, essentially what this is really doing is it's a short-term deferral in your ability to write off any current business losses, especially if they're over that, $250,000 amount. The reason the IRS is doing this now is they are hoping that this is going to raise about $150 billion over the next 10 years. So who will this especially hurt? Who are the ones that this is definitely targeting? Well, if you're a non-corporate taxpayer and you have significant current year non-passive, so we're talking about like active business losses, you might not be able to use those losses. On the other hand, if you're a non-corporate taxpayer with significant current year income from non-trade business sources, you will also be subject to this 1% excise tax. The other one that's an interesting target of this is if you are a property owner and you've had significant passive activity losses that have been suspended, you haven't been able to use them over the years, and now you're disposing of that capital asset, well, that passive activity loss has become an active business loss, and guess what? It's now going to be subject to that 1% excise tax. So you really want, this sounds silly, but if you're trying to avoid the 1% excise tax, you do really want as much business, not non-business, you do want trade or business income as possible so that you're topping up that $270,000 threshold and you're not subject to a disallowance of these excess business losses. A question that comes up often on this, again, because this is not necessarily new, they've just extended it, is, well, what happens if from a federal perspective I'm denied these losses? What happens from a state perspective? Well, it's kind of all over the place. We don't actually have state conformity on whether or not they're going to follow this, so it depends on the state. And the issue for that is if you are a non-conforming state, so you've decided, well, these rules don't apply to us, you're going to have a difference between your losses for federal purposes and your losses for state purposes. So essentially, you will have a federal versus state NOL mismatch. Again, this is one of those areas where you're going to see a lot of CPAs and practitioners waiting for some more guidance, both from the IRS as well as from states. Next one I'll talk about here is the R&D tax credits. So this is essentially targeting small startups. So if you are a corporation or a partnership with less than $5 million in revenue, and you've been making that less than $5 million of revenue over less than 5 years, this is targeting you. So the industries that this is especially impacting are those with substantial R&D investments before you've really generated sufficient taxable income. So here we're talking about life sciences and those in the technology or medical devices field. So what's really changed here is that since 2016, anyone that was a qualified small business can elect to have $250,000 of their R&D credit to be applied against the employer portion of their payroll taxes. So that's essentially, we're talking about FICA, or the Social Security taxes. But now, with the Inflation Reduction Act, starting after January 1, 2023, that maximum amount of your R&D credit has been doubled. So we're going from $250,000 to $500,000 that you can use against your employer payroll taxes. That additional $250,000 they're offering can also be used to apply against an employer's Medicare payroll tax liability. Also, if you're using that $500,000 credit, it can also be allocated amongst different entities within a related group. So there are aggregation rules you have to apply there. Also, if you are subject to the R&D tax credit and you do not use it, you are allowed to carry over that amount into a subsequent year. All right, so I want to talk next on this one has actually gotten a lot of buzz in the news. When people talk about the Inflation Reduction Act, it's hard not to politicize it. It's hard not to talk about how, the Biden administration is bringing obviously their own kind of political tint to it. So I want to talk about some of the green energy initiatives that have come out of this. And again, the reason I say it's very similar to some of the budget proposals mentioned by Jamie is the first ones you'll see are really targeting homeowners. So the first 3 tax credits, let's talk about how it impacts homeowners. The first one there, it's a tax credit umbrella for all sorts of different home improvement projects, which are geared towards providing overall energy efficiencies. So the first one there, qualified energy efficiency improvements, think here like building envelope improvements, so things like insulation, energy efficient windows and doors. To be eligible for this, you do need to meet certain Energy Star requirements. You have to be the original user for it, and that home needs to be your US principal residence, and you need to expect that that improvement is going to last for 5 years. The next one here under that same umbrella is the residential energy property. Think here more around energy efficient versions of appliances that either cool or heat air or water inside of your home. Again, this is things like heat pumps, central air, water heaters, furnaces, and boilers, as long as they meet that highest energy efficiency tier. The next one that also falls under this umbrella is home energy audits. That's kind of exactly what it sounds like. You get a home energy auditor, knocks on your door, comes to your home, and they're going to identify the most significant cost-effective energy improvements that you could make to your principal home in the US. Next one here, residential clean energy credit. This is essentially any sort of solar panels that you have for your home. The next one, this one's actually an interesting one, electric vehicle charger credit. So the maximum credit you have for an electric vehicle charger is you get 30% of the cost as a credit. But what the Inflation Reduction Act has done is it's actually changed the amount that would be subject to this credit from $30,000 to $100,000 if the project is completed after 2022. So really, any building owner can install an EV charger in their parking garage or lot to be eligible, but to be eligible for the full 30%, it needs to be in a low-income community or rural area. Otherwise, that 30% goes down to 6%. The EV charger also needs to be new, it cannot be used, and again, it has to be located in the US. The reason, by the way, this is pretty important, again, not just because they're looking at a $100,000 cost, but also the timing of it. This is great for a lot of taxpayers. This equipment generally is very expensive, and the timeline to complete a project like this can be very long. All right, I want to talk about 3 other green energy initiatives. This first one, the 179D revamp, this is essentially a depreciation acceleration trick. What the IRS has done with the Inflation Reduction Act is it has expanded the properties that are eligible for this. So we're talking larger buildings, think like 4-story buildings, schools, hospitals, commercial buildings. And the way it works is if a real estate investor purchases a new energy efficient building, or let's say they make a deep energy retrofit to an existing building, then that investor can deduct a giant piece of that asset cost in that first year, instead of waiting several years to depreciate it. So that's quite significant. The only thing you want to make sure there in terms of certification is that you do need an independent licensed engineer or architect to certify that it's going to meet the energy savings targets. The next one we have here is solar panels on commercial buildings. So the tax credit for this is 30% of the cost of the panel. And the nice thing about this is the IRS is treating this as a 5-year property for depreciation. And that's great because these things can usually last between 25 to 30 years. 5 years is actually pretty generous. Again, just like the other ones, the panel needs to be new, needs to be located in the US. You need to hold on to that property for at least 5 years. And the other thing here, and this hasn't changed by the way, this was there before the Inflation Reduction Act, is the solar panel, while you're providing this credit, needs to be installed in a way such that it's meeting prevailing wage and apprenticeship rules. And all that really means is that you're paying your workers, your contractors, your subcontractors, the installers fairly. Otherwise, that credit goes down from 30% to 6%. All right, here's another one that's also got a lot of buzz in the news, especially here in Canada, the electric cars credit. So there's 2 different legislations here. There's Section 30D and there's Section 25E. Section 30D is effective immediately. And the way the legislation works is if your electric vehicle had final assembly in North America, then you qualify for the $7,500 clean vehicle credit. Now they're saying that this could really change the supply chain of North American made electric vehicles. And the reason for that is you need to have that final assembly in North America, or at least the components, things like the batteries, done in North America. The other interesting thing here is when you look at who is eligible for this credit, there is a maximum AGI, so it's $150,000 or $300,000 if you're married filing jointly. And you know, it's interesting, so the IRS released an FAQ about this a couple of weeks ago, and the US Department of Energy released one last month saying, here's a list of the 2022 and the 2023 model vehicles that they know have final assembly in North America. And what you notice when you go through that report is that they've drastically cut the electric vehicles and plug-in hybrid models that are actually eligible for this credit. So for example, Kia and Porsche, final assembly outside North America, they lose their credit. Tesla and GM, they now do see the credits. So if you're a purchaser of those vehicles after December 31st, 2022, you're now eligible for this credit. The other interesting change here too is they have knocked out the higher priced and luxury electric vehicles. So $55,000 for passenger cars, that's when the phase out happens, and then $80,000 for vans, SUVs, and pickups. The other one I want to mention here real quick is Section 25E. So that is a $4,000 credit, and that's for purchasing previously owned clean vehicles. It's $4,000 or 30% of the purchase price. Another one that's gotten a lot of buzz in the news with the Inflation Reduction Act is the ton of money that's going to the IRS. So if you look at that chart below, and I just did a small extract there, you're going to see that the IRS examination, or they call it the audit rates, have been really low during COVID, especially when you look at 2020. So if you're a company with less than $250,000 in assets, only 0.1% of those companies actually got audited by the IRS. So what the IRS is hoping to do here is they have provided an additional $80 billion in funding, in addition to whatever's currently already appropriated towards the IRS, for a period of 10 years, beginning with September 30th, 2022. By the way, of that $80 billion, $45.6 billion is earmarked for civil and criminal enforcement. And there's talk that this could create like up to 85,000 new IRS agents running around. The reality is the IRS has been plagued with staffing shortages and technology challenges. So they're thinking that a lot of this money is going to go towards creating that enforcement capacity and hopefully upgrading their computer systems. The Treasury has also given the IRS 6 months to come up with a plan on how they're going to spend that $80 billion. By the way, that's not an enviable position. The next person who's replacing the IRS commissioner, who retires, I think, in November, he's a Trump appointee, they're going to be in the middle of a political storm. Because basically, they're going to walk into this position, and they need to figure out how best to spend that money. And you have a bunch of people who are looking at this and saying, this IRS funding is really just going to go after middle-class taxpayers. So not an enviable position. He's going to take it from, I think, Rettinger in November. Good luck. On the other hand, the IRS thinks this is going to have a great ROI. They're going to spend $80 billion, and they think they're going to get $200 billion of more taxes as a result. One other thing just to add here is, in the US, generally when you're dealing with the IRS, no news is good news. I say that because unlike Canada, IRS does not provide you with a notice of assessment for every tax return that you file. So generally, if you haven't heard anything, it's probably a good thing. All right. Last but not least here is a 2022 cannabis CBD update. I want to mention here some of the developments that we've seen in 2022. Primarily, we're seeing that the IRS audits have ramped back up in the last quarter of 2021 as well as now in 2022. We're seeing that there's a lot more expanded IRS training of agents involving cannabis audit practices. And a recurring theme is audit preparation is key. You want to be well versed on tax laws, you want to have your financial statements in order, track your employee time, and document all gross receipts and expenses. In looking at some of those audits, one recurring example we're seeing over and over again is they are confirming that companies are filing Form 8300, which is a required IRS form if you have cash transactions over $10,000. The other big development we saw in 2022 is the Cannabis Administration and Opportunity Act. So this is a social equity legislation. It was introduced by Senate Majority Leader Chuck Schumer in July 2022. The gist of it, remove cannabis from the list of federally controlled substances, allow states to continue to take the lead on regulating the industry, and provide for a national excise tax. Now, it's unlikely this is going to pass the 60 votes in Senate. And honestly, probably nothing is going to pass between now and November. We've got the midterm election, so expect nothing between now and then. But what this does do is it does provide momentum for the Safe Banking Act to come next, which would be to provide protection to banks to serve the cannabis businesses. Look, with Code Section 280E, many cannabis companies are finding themselves in much higher tax rates compared to other businesses, because essentially they're getting taxed on their gross income and not their net income. So how does a business survive Section 280E in an already competitive environment? Short answer is you can't get around Section 280E. It's a tax code. It's got to be applied to your cannabis business. But what you can do is track your expenses carefully, know what costs are allowed as an allocation to your cost of goods sold, and calculate those costs that are directly related to the preparation of your goods for sales accurately. Now, some of the tax planning opportunities that we're seeing in today's market to deal with Section 280E come down to minimizing your non-deductible SG&A costs. So now we're talking about advertising, utilities, repairs and maintenance, travel expenses, those costs that generally relate to running your business, which are subject to Section 280E and not related to your inventory. We're also seeing companies getting the optimal business structure that can fit their operational needs. Another one we're seeing is US companies are trying to divide their business and their employees, including their time, between cannabis and another active business that's not subject to Section 280E activities. So that could be an active business that does selling shirts, hats, cookbooks, whatnot. But with those increased IRS audits that we're seeing in 2022 and 2021, the IRS is still maintaining a steady focus on looking at those separate divisions within one entity. So questions we've seen in some of those audits is they're asking, is this really a separate business? What overlaps are there between these separate businesses? And how are they allocating expenses between those separate businesses? All right, so I've really only scratched the surface here on the Inflation Reduction Act and the 2022 U.S. tax update for cannabis. Really, for the Inflation Reduction Act, we'll see how this bill translates into immediate, meaningful changes in Americans' wallets, and for those of us that do business with the U.S. To know how some of these U.S. tax changes can impact you and your business, please reach out to our cross-border tax team. Thank you so much, and let's thank my colleague.
Great presentation there, NAMIR. And for those of you that were around when Jamie presented, I want to respond and just set the record straight that I do not own a village of properties where I'm flipping back and forth here. And I don't plan to put my son out on the streets. It's great to see everyone here in person again. And hopefully some of you have had a chance to travel. My wife and I, we were able to go to Paris for our honeymoon after 4 years of delays and setbacks. And I recall being in the Louvre and just trying to navigate through a difficult, large space. And what really helped me out was the use of pictures and symbols. So in my presentation here, I plan to incorporate some of that theme into it. So I present to you the illustrated edition of this. The flow-through share terminology is sort of thrown out there, and it's used for various things. Such as in US taxation, you have flow-through entities. Even in the CPA magazine this month, they wrote in effective flow-through tax rate. So I want to make it clear that this is not what we're talking about. Flow-through shares refer to businesses that are in the mining industry, the resource industry, and that includes, it is related to something that is in a principal business. So what's included in a principal business here? It's petroleum and natural gas, so oil and gas, or ONG for short. There's clean energy or renewable energy, and there's mining, as I alluded to just earlier. And because we have a lot of clients in that space, I want to sort of direct this presentation towards that. So the best way to walk through the mechanics and the regime is to go through an example. So let's say we have ABC Mining Corporation here, and they have a resource property that's in Canada. So what investors generally look for is potential return on their investment. And without the flow-through share mechanism, it might not look as attractive to a potential investor to invest in a loss corporation. So what flow-through shares allow companies and investors to do is pass on those losses or those expenses to the investors so they can deduct them on their own tax returns. So let's say, I was going to call him Bob. So investor comes along with a bag of money, but let's call him Jamie here because he threw out my name a few times. And he's already bought his yacht. He's got this $1 million. He wants to invest in ABC Mining Corporation. He likes what they do. So he'll sign a flow-through share agreement here if he wants to invest in those in flow-through shares for this company. And there's no difference from common shares to flow-through shares, other than the fact that this agreement was signed, right? So it's a regular thing where you exchange share certificates for that cash, that consideration. And in that agreement, it states that the company will incur expenditures on a mineral resource property and then renounce that to the investors. So that flow-through share agreement is very key to all of this. So the next stage after a company raises the funds from the flow-through share raise is to spend it. So spending it on that mineral resource property here, they will incur Canadian exploration expenses or Canadian development expenses. So CEE or CDE for short. There are reasons why you want to just focus on CEE, but we'll get to that when we get to renunciation. So that CE would be reported on the corporation's tax return, and it would be part of that corporation's pool. Now, had that flow-through share not been signed, flow-through share agreement not been signed, this is where the story ends, right? But that the agreement gives the power to renounce. So renunciation, or to renounce the expenses, is a fancy way of saying that the expenditures will no longer be expenses of the company and will now be deemed to be expenses of the investor. So magically, that CE and CD will flow through to the investor, and hence the name of where this all comes from. and the investor can claim that deduction on their tax return. The reason why a company might prefer to only renounce CEE is because of the deduction rate of 100% versus CDE, which is at 30%. So you'll see a lot of agreements just drafted that way for CE renunciation only. There's also restrictions on what can be renounced, and typically what goes into CDE might be capital in nature or a capital cost of the mineral property, so you can't renounce it at all. In addition to the CE and CD deductions, the investor also gets ITCs, and this gives rise to the name of super flow-through shares or other attributes. Like it's a marketing angle to try to attract more investors. But again, this is just a common share with a flow-through share agreement signed.
What does ITC stand for?
Investment tax credit. So someone asked here what ITC stands for, not to be confused with GST ITCs, which are input tax credits. These are investment tax credits. And that's a good question. It's both federal and for provincial. So you can't have your cake and eat it too, as they say. So the investor has deducted 100% of their investment as CE. The shares now have an ACB of nil. That way, when they sell the shares, there's going to be a full capital gain that they claim on rather than what they had paid. So if Jamie had paid $1 million for those shares, the ACB is not $1 million, it's nil. So whatever he sells it for proceeds is going to be taxed completely. So in all of this, obviously, the Canada Revenue Agency, CRA, wants to know or understand what's going on in the country, and this raised spending and renunciation needs to be reported to them. So there's specific reporting requirements and deadlines that have to be paid attention to. I won't go into detail too much with that, but know that there's an obligation for the mining corporation to prepare flow-through share tax filings on a timely basis and send those to the CRA. Or they could reach out to their friendly neighborhood accountants, and they will help to do so on behalf of the company. So now we've gone through the general overview. Let's understand what might be deemed to be or allowed as flow-through eligible expenditures. It's kind of broad in the Income Tax Act. And it's not until you go through an audit with a CRA or look at in detail to find out what can or cannot be accepted as CEE or CDE, and there's specific resource pools there. So grassroots expenditures refer to something that is setting up the company, the whole business for the mining resource property. And pre-production expenses are what happens before the company starts earning income on that resource property. Now, keeping in mind with all this, there is a term that's always thrown around, which is the purpose test. And that's referring to activity that it relates to determining the location, extent, quality of that mineral resource on that mineral resource, for that mineral resource on the mineral resource property, right? So everything that you do has to meet that purpose test. And you might say, yes, well, everything that I'm doing in my mining business relates to that, so it should all be deductible. But there's more ineligible expenditures that they outline. And as I mentioned before, there is mineral property acquisition costs that aren't allowed as renounceable or flow-through eligible expenditures. There's also something called CDO, which is Canadian Exploration Development Overhead Expenditures. And that's for anything related to administration, financing, management. If the employee wages do not relate to 90% related to exploration and development activities, those wages also would not be deductible. And you might come across that if a director has a split between their management role and being a geologist. So having that clear line of what their roles are will allow those wage expenses to be deductible. Otherwise, the CRA could challenge that and say, well, they're managing the company, so they don't meet that 90% threshold. Other things that aren't deductible are capital costs, like equipment. Obviously, the CRA doesn't, or the Canadian Finance Department does not want companies taking investor money and buying capital items such as their drills and other machinery. The other thing, assistance, this refers to both government assistance as well as any reimbursements by some other party. So you have to be aware if the company is receiving that assistance, including tax credits that they applied for, like the BC METC. Certain seismic data is also not eligible expenditure, and that's off the shelf. So if you bought it, it'd be considered as data, sort of like software. But if you had created that seismic data from your geological services, then that's okay. Personal expenses, obviously, that's not deductible either. So let's take a look here now that we understand what can be eligible as an expense or in that realm. Let's see how that can be passed on to investors. And there's two ways to do so. There's either the general rule or the look-back rule. So let's look at general rule first. So let's pretend we had a raise today. It was in September, and the rule is that you're allowed 24 months after that month to spend the funds that you received from that flow-through share raise. So we'll take this example where you spent it between October and December, a portion of it. So taking Jamie's $1 million, let's say we only spent 200,000 of it, and we renounce at the end of the year that $200,000 to Jamie. So he gets a tax slip for 2022, and he can claim that as a deduction on his tax return for that year. Now, you can continue to do this as many times as you want throughout that 24 months under the general rule. So, Jamie will now get a 2023 tax slip. You can even have 2 of them. And then in that final year, let's issue out another 2024 one. And the investor will look at this and say, well, why are you giving me 4 tax slips? And why do I have to wait 2 years to do this? It's not a very attractive position. So what companies end up hearing is, no thanks to that, we'd rather get the deduction as soon as possible. So the way that you can do that is through the look-back rule. And this is only if you're not a related party to the corporation. So same scenario where you have a raise in September, you spend it. This is still under the general rule because it's in the first year, but the difference is that $800,000 that wasn't spent can be renounced as at December 31st to the investor. So Jamie gets his full $1 million CE on his 2022 tax slip, and the corporation now has $800,000 that are unspent. So you might think of this as being unfair or it's kind of skewed, and the CRA thinks so too, or the finance department. So they established or created a system where the company can now spend that $800,000 in the following year, and they will accrue what's known as Part 12.6 tax. And that sort of works like interest. So at the end of every month, whatever's not spent will incur or accrue this Part 12.6 tax, which is fully deductible. And until the end of the year, we'll see if there's any more unspent amounts. And there's a filing deadline the following year after that, in 2024 in this scenario, where a form needs to be filed to say, okay, well, this is what was unspent at the end of every month, and here's the Part 12.6 tax, we paid it, everything's good here. So these are the 2 ways to renounce to the investor. Now that we understand that, let's look at something more complex, but not so much in the pubco space, because you see tiered structures all the time where it's a parent holding company that's just listed on a stock exchange that holds these holding companies that have the mineral resource property. But we flip the names here, so the holding company is actually the holding company of ABC Mining Corporation. And the difficulty here is that the holding corporation does not have rights to explore on that mineral resource property held by its subsidiary. So imagine if your neighbor had a backyard and you started digging in their backyard and you incurred a lot of expenditures. Would that now be deductible for your business? Well, you didn't have rights to that property, so the CRA is going to deny that, or under the tax legislation. So there has to be something in place that allows the parent company to have rights to explore. And that public company might have already issued shares out to investors. So they're now put in a situation where how are they going to incur CEE to renounce to their investors that where look-back rule is allowed because they're not related. And here, because holding company holds 100% of mining corporations' shares, they are related. So one option is to use an earn-in agreement, and you've probably seen this with third parties already, where a company will incur CE on that resource probably held by another entity, but because of that agreement, they've allowed that to happen. So that will give them the right to incur CE on the mineral resource property. But one thing to note here is if you use this method, the holding corporation at the top, the parent company, is now going to earn a beneficial interest in that mineral resource property. So you might not want to have that, because once they earn 100%, you might have to change all the titles over to the parent company, and it changes your structure altogether. What's the point of that subsidiary now? So another option that you could use is what's known as a back-to-back arrangement, or a stack structure, stack flow-through share structure. And here, because the subsidiary is related to the parent, they can't renounce using the look-back rule. So you can only use the general rule, but as we looked at before, you can renounce under the general rule as many times as you want throughout that year, as long as it's within the 24-month period. So this is how it works. The subsidiary renounces up to the parent renounces out to the external investors, and everyone's happy. We can't really get away from COVID-19 just yet. There was relief that was provided to junior mining corporations, and it allowed the general rule to be extended by additional 12 months. So this applies to flow-through share agreements between March 1st, 2018 to December 31st, 2020. So they've extended that and for the general rule, and there's something similar for the look-back rule here. So as we saw before, this was a scenario where you only had until the end of year 2 to spend the financing dollars that they raised. Well, that was extended by a year as well. And that first year right after will now no longer incur Part 12.6 tax. It's been pushed out a year. And the mechanic is kind of magical, because they take anything that was incurred in 2021 and deem it to be, all those expenses are deemed to be incurred in January, which has a Part 12.6 tax of 0. So it's as if it was a free year. And then they take everything that was in 2022 here and roll it back 12 months. And that's how that Part 12.6 tax is accrued. The filing of that is also pushed out a year, so now in 2023. So it's still on our scope of work to do in the upcoming year. Just keep that in mind when you're looking at these flow-through share arrangements. Now to something more recent, Federal Budget 2022. There's an image of the future that's been pitched, where we are now going to hit net zero emissions by 2050, and there's a lot of clean energy technologies that we're trying to promote, or at least that activity amongst our society. So the finance department is trying to follow along the same lines, and included in the flow-through share regime for principal business corporations, as you remember, there's oil and gas and other mining activities, including coal. So those will be phased out from the flow-through share regime as at March 2023. Now, this is still proposed. If you are in this industries, you can, by all means, write to your MP and tell them that this is a bad idea. But this is where the legislation is at right now. The other thing that they want to introduce is something called a critical mineral exploration tax credit, or CMETC. And this doubles the federal ITC that we had discussed before, which was at 15%. This is now 30%. And it applies to anything that is a critical mineral. So what are those things? Well, it includes copper, it includes nickel, and then a whole slew of other elements that are difficult for me to read, so I'm just going to list them out here on the screen. One of the things that if you are in this space to be aware of is that it must be certified by a qualified engineer or geoscientist. And this is different from the NI 43101 definition of a qualified person. This qualified engineer or geoscientist is currently defined in the draft legislation that was released last month as someone that belongs to a Canadian profession. And professional organization. So you have to be aware it doesn't apply to international geoscientists. And the other thing too is that flow-through share agreements after budget day, which was April 7th, 2022, and before March 31st, 2027. So you can absolutely start on this process to set your business up for these flow-through share issuance relating to CMETC, but it's not finalized. Let's talk about pitfalls here. One of the most major ones that we see is that we find out Jamie is a Quebec resident. And what that means is there's going to be a set of Quebec filings that need to be sent to Revenue Quebec. And you find out this quite late. This could happen quite late in the process of raising all those funds. And what that means is there's going to be late filing penalties because Quebec does things separately and they have their own set of Quebec flow-through share filings. One way to prevent this is early on when you're looking at your investors, make sure that you don't have any Quebec resident investors, and that applies to funds as well as limited partnerships. And if you need help on that, we're here to guide through that process. But it is a big deal right now because in the last year, Revenue Quebec actually set up a separate department in their organization to aggressively go after funds that have not applied or have invested in a corporation that has not filed these Quebec filings, because the investor needs to be able to deduct those amounts. Revenue Quebec looks at it and says, well, you don't have the proper documentation, and those investors will now go to the mining corporation and say, well, I need a Quebec RL11 slip, for example. Major pitfall number 2 is that the company has a raise in September, but they also had a news release back in July. That news release counts as what's called a selling instrument under the Income Tax Act. And a selling instrument can include anything like a term sheet, offering memorandum, prospectus, or any similar document that contains the price and number of shares issued. And guess what? A news release where you're trying to promote your flow-through share raise, that will include that information. So because of that selling instrument being delivered to a potential investor, the deadline is actually the month after, in August. And when you tell your accountants in September, hey, we finalized our raise, our flow-through share raise, please do our filings, well, now they're overdue because it was due in August. So that's something to keep in mind, that there are requirements to file to both CRA and Revenue Quebec if you had that selling instrument to a potential investor. Major pitfall number 3, as we covered earlier, this parent sub situation. What if you didn't set up one of those options? Well, now all of the renunciations that you thought were CE could be denied by the CRA, and they could deem it to be for nil because it's between related parties and no consideration was given. And now you'll have a lot of upset investors. So make sure that you talk to somebody about the structure if you do have a parent company and a sub. The issuance of flow-through shares and renunciations to external investors without the rights to incur those CE, as it's stated there on the slide, that's one of the big deals. You can also look at winding up amalgamations, but that's going to change the structure of your corporation and have other tax implications that you want to discuss about, like those losses that Les had mentioned earlier. There are also other pitfalls here. Flow-through unit price sometimes is used inter-exchangeably with flow-through shares when it shouldn't, because a flow-through unit price could include a warrant portion as warrant for a non-flow-through share, as well as regular flow-through shares. And depending on what's written in your flow-through share agreement, you might want to carve out that warrant portion. There's also the pitfall of not having flow-through eligible expenditures. Again, there's no exhaustive list for what is eligible and what isn't, so you have to look at it case by case. And that's usually a headache for those in the mining industry and in that resource space because it's not clearly defined, although the CRA does have their own CRA mining expenditure review table. So it's worth taking a look at that table, but it's not exhaustive by all means. Another issue is that you miss the deadlines for whether you knew about it or not. Spending outside the allowable period, as we discussed, COVID-19 relief, thinking that it was going to apply forever from COVID-19 onwards, and now it's no longer there, and it's not extended past 2020. And then this terminology of effective date of renunciation versus date of renunciation. Because they're so similar, it's oftentimes, again, used interchangeably by accident, and they do mean different things. The effective date of renunciation is the date that all the expenses are deemed to be the investors and no longer the expenses of the corporation. That's what we discussed earlier. The date of renunciation is when you're actually filing that form to say, hey, we're going to have these expenses deemed on the EDO, or the effective date of renunciation, and pass those on. And the date of renunciation is the earlier of when a tax slip is given to an investor or when that the form is signed and submitted. So oftentimes those are confused. That's my presentation, but in closing, I will leave everyone here with a modified quote from John Maxwell. And thank you again for your time and coming to join us here.
All right, thanks, Frank. I think that's been the most entertaining description of flow-through shares that I've seen. So great job. Thank you for that. And again, if you do have questions, I know we did see a few roll in. If there's any questions in the room, please make note of them, and we'll have our admin team come around to collect them. So the last sort of presentation for today includes a couple of areas, kind of a potpourri of issues that a lot of our venture capital public companies encounter. GST for holding companies, basically where the parent company is listed is the public company, but the business is actually contained in a subsidiary of it. Qualifying for the input tax credits can be a challenge, and the rules changed a couple of years ago. The audits around those are still coming through now, since they're usually delayed, and despite it coming into effect earlier. So we'll talk a bit about that. And the other is something that's more, I guess, come up lately or in the last year or so is different ways to compensate executives through stock or stock-based type of compensation. So just some basics there so that you can understand if you are considering these that are sort of beyond what we often see of stock options, but different types. So starting with GST. So GST for holding companies. So basically, we'll go through a background of what it takes to be eligible to claim an input tax credit and recover the GST that you've paid on your expenses. The restrictions on ITCs and what the relieving provisions are when you do have a parent subsidiary arrangement. We'll briefly talk about what the old rules were, the pre-2019 legislation, as well as what the new rules are, and that's essentially post from July 2019 onwards. So just quick background on it. So GST is that you pay on your commercial expenses can be recovered through claiming it against, I guess, GST that you would otherwise have collected. In most cases where you've got like a junior mining company, you don't really have any revenue, so it's really all just refund that you're looking to get. So the basic requirement is that you have to be engaged in commercial activities. What's not included in what is a commercial activity for GST purposes includes things like financial securities and in that realm. They would be an exempt service or an exempt supply. So if that was the only item, then the criteria probably wouldn't be met. And this is often encountered when the company is in a capital pool corp status before it's really established its qualifying transaction and found the true business of the company. And what we encounter often are public companies in Canada that have foreign subsidiaries that they do have to raise capital for and incur costs in doing so. But the fact that they own a company and don't actually have the operations within the Canadian public company would not be considered engaged in a commercial activity. So absent a special relieving provision, you would be denied any ITCs on that. So where the relieving provisions kick in are under Section 186 of the Excise Tax Act. And basically the pre-2019 rules were that if you incurred expenditures that were in relation to the shares or debt of the subsidiary and all or substantially all of the subsidiary's assets were used in a commercial activity, then you would qualify. So the parent would be able to recover the GST it incurs on its professional fees and other types of administrative costs that it incurred in order to actually raise capital and fund this subsidiary. So examples of that, like we said, accounting fees, legal fees, those types of things that often the parent encounters. So prior to July 2018, the taxpayer position was always, or typically what you would take was that the only reason for the existence of the parent company was to essentially hold the shares of the subsidiary. So because of the wording of the previous legislation being a little bit broader, it allowed you to basically take the position that the only reason for the public company was because of this business. So typically you would have a positive result. A few years prior to that, CRA started to clamp down and take a more aggressive position. And we encountered several audits where, despite there being a broader wording of that legislation, CRA was taking a much more narrower approach or narrower view on what those were. And so it was an ongoing issue with the auditors and having to address these issues. So what the CRA then went on to do after a court case that found in favor of the broader interpretation, and that was the Med-C Copper, was that they essentially let that stand and did not want to take it beyond to a tax court where there would be a precedent set, so that they could continue to take their narrow approach without there being a legal precedent that would counter that. So up to that point, it was a little bit of falling into gray area, and depending on who you had as an auditor from CRA, you would have a different outcome, essentially. Once July 2018 came along, the government essentially established a restrictor set of rules. So after 2018, they narrowed it to say that the proceeds, the transactions could only be involving the shares and debt of the subsidiary, the operating corporation. The proceeds had to be transferred to the subsidiary operating corporation, and the other activities of the holding company, the new test was that it had to be a 90% test, not the 50% test that was there prior. So it became somewhat more difficult to maintain or to be able to qualify for many of those expenses. So as they went through that, they changed the wording, and now as we encounter these audits, you still get the same sort of effect where you can argue that there are certain expenses that were relating to the shares and debt, but it's a much harder argument to make. So we understand that there's still ongoing GST audits out there. Unfortunately, the end result is that more of those ITCs are going to be denied. So it's more of a caution to consider that if you're relying on those GST refunds, to manage operations and to provide cash flow, to be just aware that taking a conservative approach to how much you'll actually get back from those refunds is likely the outcome. So that was just the little coverage of the GST that we wanted to touch on. The rest, we just wanted to have a quick few minutes to run through and give us a few minutes for questions. So we'll just kind of run through these. So obviously stock-based compensation is intended to basically compensate based on the performance of the company and in line with the incentives that apply to shareholders and those others that are involved, and as well as being on a tax deferred basis, so that the tax hit is going to be further down the road, but yet you're able to attract talent using it. So the different types are, as we've encountered, I'm sure, with many that are in the public markets. Stock options are typically the go-to for most public companies. Restricted stock, which is actually just literally stock with a term on it, not less so because they are quite punitive from a tax point of view. Then we have restricted share units, which are, again, they have to meet conditions, and we'll go through quickly. performance share units, which are quite similar to RSUs in that there's more of a performance-based criteria in order to achieve the tax deferral, and as well as deferred share units, DSUs, which are also used often for more retirement-type compensation. And the last one, share appreciation rights. So the main goal of all these is essentially that you want to have a compensation where the individual, the executive, the employee has received something that's incentive to them, it's compensating them, but doesn't come with an immediate tax hit. The tax hit hopefully will be deferred until when you actually receive cash from that compensation that can actually pay the tax. So just a brief on stock options. It's really the tax benefit is the fair market value of the stock on exercise, the difference between that and the option price. It's generally not deductible to the employer. It's typically when you, it's taxed in with public companies when you exercise, and it is subject to payroll withholdings, which can have its own challenges in terms of cash flow. And then a 50% deduction. And normally the criteria is you have an arm's length relationship between the employer and employee, and the option price is at least fair market value on the grant date. So you're not in the money when you've granted the options. So just a few quick changes as of July 2021. So there was a cap on the amount of stock option deduction for certain situations or certain companies. They do not apply to CCPCs, which are Canadian-controlled private corporations, or non-CCPCs, such as public companies that have consolidated group revenue of 500 million or less. So this is really hitting the big cap companies that, public companies that would have executives with fairly large stock-based compensation packages. Restricted stock is really just employer awards the stock of the company subject to conditions. It's often, like I said, not common as there's some adverse tax consequences. It's essentially no tax deferral on those types of arrangements. Contrary to that, under the RSU arrangement is that the RSU is really awarded to employees with vesting conditions, and they're generally based on time or performance or a combination. They're either settled in shares or cash. They can be deductible to the employer in the year that it's paid. And the real key issue here, in order to make sure that it remains on a tax deferred basis for the employee, meaning they're not getting taxed when they're granted the RSUs, but when they're actually being settled, whenever those conditions are met that are tied to them, right? So the key issue is to avoid what's called salary deferral arrangement rules under the Income Tax Act. And what that essentially does is it accelerates the recognition of that income for tax purposes up to the date of when it's granted. So there's a few ways to get out of those rules, and that's usually what you rely on for RSUs, PSUs, and as well as the DSUs. So to be exempt, the plan arrangement has to be received or settled within 3 years following the end of the year. So you really normally, when you see these structured, the RSUs, they have a term that's not going to exceed 3 years so that you meet this condition and it doesn't put you offside. But what you should watch for is if it awards the employee for periods prior to that date. So you don't want to have any kind of language in the agreement that says it's compensating the individual for work that they did prior to that. This is forward-looking so that your 3-year window doesn't get too short in order to meet that condition. Essentially, it would start where the actual period of service that you're getting paid for is what starts. Performance shares, really, the main one here is in order to avoid the SDA rules is if there's a substantial risk that one or more of the conditions won't be met. So that's the real key there. And that would be risk of forfeiture. So it has to be definitive and it needs to be a high threshold. So if you're relying on that, just be cautious. Probably get a legal opinion before you do. The next one, deferred share units. This is, as I said, this is more often for retirement type compensation structuring. They're essentially meant to come into effect when the employee is, or executive, the employee is no longer with the company. So that's either because of retirement, loss of life, or just basically left the company. And so in order to ensure that they're met, they can either be settled in cash or shares. It can be deductible to the employer in the year that it's paid, and it needs to meet the prescribed plan or arrangement. And that's basically these 5 criteria. So agreement has to be between recipient and employer. The DSUs attributable to the duties of office or employment. All amounts under the arrangement must be received after time of employee's death, retirement, loss of employment. The amount must depend on the fair market value of the shares, determined at a point in time within 1 year before death, retirement, loss of employment, and the payment date. So that's a little bit of a bag of words. It's really just to say there needs to be no committed guaranteed payout associated with this. It has to be based on the fair market value of the shares and not a guaranteed minimum value. The last one that we're going to talk about is, and we're just about out of time, we'll go over maybe a few minutes, hopefully everyone's okay with, the share appreciation rights. These are essentially to compensate the employer, the executive, with the increase in the value of shares over time, even though you're not actually holding the shares. So the idea is that it's taxed when it's settled. They're also known as phantom stock plans. But this as well would rely on that 3-year window to make sure that you don't violate the SDA rules and become taxable immediately. So as we said, 3-year exemption applies. The rights cannot have any value on the grant date, so they have to have nil fair market value. Essentially, you're saying that all of the appreciation in the value going forward is what's being provided to the employee. And the actual payment date is fixed, and it's based on a future date. So that covers the quick sprint through the stock-based compensation. So we have a brief Q&A session. I think we had a few. Sorry?
You want us to answer them?
If you'd like, yeah. It's I can read them out, or did you? I guess you guys can read it out.
Yeah, because I think we got them all.
Yeah. So
Okay.
I'll let Jamie take over. I think there was a couple for you there.
Yeah. Sorry, I was changing gears there because I know we're already at 4 o'clock, and I know people are anxious to get some booze in them. So I just have a couple questions that I'll try and answer really quickly on my topic on the federal tax budget highlights. So the first question, for the first-time home savings account, does the taxpayer have to return back the money, I guess, to the account similar to the home buyer's plan? And the short answer is no. This is like a TFSA on the tail end. So you contributed $40,000, it grew to $70,000. Presumably, when you want to buy a house, you take that $70,000 out, use it for a down payment, for example, and that would be tax-free withdrawal. That's the idea behind it. The other question, admittedly, is a really good question and something I should have addressed during my presentation, and it's can the first-time home savings account be used in tandem with the home buyer's plan? And the answer is actually no. So you do have to figure out which of the 2 plans is optimal for you and really just choose one. So for those of you who aren't familiar with the home buyer's plan, it essentially allows you to pull up to $35,000 from your RSP and basically repay that over a 15-year period. As many of you know, when you normally withdraw from your RSP, it's taxable immediately in the year of withdrawal. So definitely have to figure out which of the 2 plans is optimal for you.
Can husband and wife combine one of each?
Ooh, good question. I think it's based on a per taxpayer, so I would think it's per person. Good question, but I would think it'd be per person. And there was another question. It was I think it's more of a joke. It was wondering how anyone could use $40,000 as a down payment in Vancouver. So
In this market.
yeah, in this market, I have no idea either. When you know that answer, just let me know. So that's it for me. Thanks, guys.
Okay, so a few flow-through share questions I've gone through here, and I'll try to answer them succinctly. The first one says, can you discuss the impact of back-to-back arrangements for flow-through shares from parent co to subsidiary co that owns the mineral asset where the exploration activity would take place? What is the CRA's position on the review of these agreements? So we covered that back-to-back stacked arrangement in the slides, but what you want to have in place is a stacked flow-through share agreement, and make sure that the shares are actually issued. Like we discussed, flow-through shares are common shares, so make sure the registries are up to date. That shows the issuance of those flow-through shares. If a 2022 sub-agreement has a renunciation date of December 13th, 2022, but the agreement defines an expenditure period as 24 months, which date applies? Well, if the agreement says that you're going to renounce by that date, you're going to fulfill that agreement, right? That contract, the date in your agreement, because that's a legal obligation to do so. So the investor could go after you through the indemnity clause if you don't fulfill that. But yeah, otherwise you would have a general rule of 24 months. So I would talk to the investor to see if they're willing to extend it if you didn't have the expenses at that point. Are exploration expenses required under an option agreement flow through eligible? Well, as we discussed on the slides, it depends, right? And if you have specific questions about what expenditures would qualify or would not qualify, feel free to reach out to us and we can discuss that. So next one here. What date can be used to start tracking flow-through expenditures? It's the date of the agreement that's signed and entered into by the corporation. So if you sign an agreement, you can start tracking flow-through expenditures and renouncing that to that one particular investor. What the CRA and Revenue Quebec have not done, or at least I have not seen, is start tracking it by that investment amount per investor. But that's potentially something that they could, because the earliest date is by agreement. And then I believe there's one more here, and it's a major one. Flow-through investors prefer flow-through at year-end, companies at beginning of year, so they have time to spend. What happens if not all of it is spent? So I didn't cover that because there's a plethora of issues if you don't spend it by the year-end. That includes an additional 10% Part 12.6 tax if it was under look-back. The investors could go after you through the indemnification clause of the flow-through share agreement, which means that the company now has to pay and reimburse all of those costs to the investor. So the lost tax credits, any expenses they would have had. On top of that, now you have to go to your accountant or do it yourself and amend all the tax slips where you had a shortfall. So that, in a nutshell, is it for the flow-through shares.